In this lesson, Trending Markets, the learning objective is you should know how to trade in trending markets. When trading a trend-based strategy, traders usually pick the major currencies because these pairs tend to trend and be more liquid than other pairs. The more liquid a currency pair, the more movement, which is more volatility, we can expect. The more movement in a currency exhibits, the more opportunities there are for price to move strongly in one direction, as opposed to bouncing around within small ranges. As traders, despite our best efforts to analyze the charts and carefully determine a bias on the charts, and trade in line with the trend of the market, ultimately, the direction of the market can quickly change at any time. Just remember that this isn't an exact science, and sometimes, despite our best efforts to make sense of the charts, the market will move in the opposite direction. Sometimes the market may look like it's trending in one direction, when in fact it's actually trending in the other direction. This is because many markets experience short-term retracements, which tend to deceive traders. For this reason, always zoom out and look at the bigger picture on the charts, and then zoom in and trade from there. Trend analysis should be only one part of your overall trading strategy to enter and exit trades. It is never a good idea to enter a trade based on one factor alone, which is why you should look for as much evidence as possible to confirm a trade. A key tip is do not overcomplicate. The most important trend to identify is the most obvious current dominant trend on the chart you're using. We can identify that by simply observing the charts. By taking a look at the general direction of the price action on longer time frame charts, we can easily see whether it is trending up, down, or even sideways. Always ask yourself, is this chart falling or rising? Don't overcomplicate it. You shouldn't have to think too hard about whether a market is trending or not. Most traders make trend discovery difficult. If you take a common sense and patient approach, it is usually fairly obvious if a market is trending or not. And this can just be done by looking at the raw price action of its chart. Although this isn't a real example, you should immediately be able to spot whether the market is in an uptrend or downtrend. You should know the characteristics of trading markets. Trading markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a retracement before the next leg in the direction of the trend. You will notice this pattern happens in almost any trend you can find. Typically, what happens to many traders is that they will make some money during the periods of strong directional trend movement, but then they continue to trade as the market takes a breather from the trend and consolidates. It's these periods where traders give up all of their gains they just made when the market was moving aggressively. You need to learn to identify the different parts of a trend. This will help you avoid overtrading during the choppy consolidation periods and will give you a better chance at profiting when the trend makes a strong move. Retracements are when we have the highest potential for a high probability entry within the trend. Often a market will retrace to approximately the level of its previous swing point before the trend resumes. In an uptrend, these swing points are support, and in downtrends, they are resistance. By swing points, they are either swing highs or swing lows. So if you're in an uptrend, the retracement you would expect to be the previous swing high, the previous high before the current bull move, before the current move higher. So let me just do a drawing. So you would have this part goes up, down, and then you have the current trend. You would expect the retracement to come back down to this level, approximately the same level as you have here, before resuming the trend higher. Candlesticks in line with the trend validate the trend. This is a great confirming factor for your directional bias on a market. Also, remember that repetitive failed candlesticks suggest that the market is going to change direction. If you have a series of higher highs and higher lows, as it is in an uptrend, when you see price break down past the previous swing low, it's a strong indication that the uptrend might be ending. Conversely, in a downtrend, there are lower highs and lower lows, and when price breaks above the previous lower high, it's an indication that the downtrend might be ending. In conclusion, trend trading is perhaps the easiest way to make money in the forex markets. Unfortunately, markets don't trend all the time, and it's the time in between trends that traders do the most damage to themselves. This damage is a result of not having the discipline to wait for high probability setups to appear, and not being able to properly read a market's price action to determine whether or not it's trending. So take the lessons you've learned in this lesson to know whether a market is trending or not.